Let's get to the broader markets. Joining us right now, Noah Blackstein, Senior Portfolio Manager at Dynamic Funds. He's in the great state of Canada. Noah, you probably want it to happen, don't you? You're ready, aren't you? But you need a new governor. That guy's toast.
I knew that was your opener. I knew it. I didn't even have to. I knew that was your opener.
Because you know why? Because I know you're like the guy in Greenland. You're ready to do it. Everybody says no one wants to do it, but you're ready, aren't you? You can't say that.
Is Greenland cold enough for the quantum data centers?
That's a good question. Are you bullish for 2025, Noah?
I am bullish.
You are? What? Why? And why aren't you worried about inflation or tariffs or multiples or any of the things that we're worried about?
First of all, I think the new administration has been historically a pro-growth administration. I think that the people who are being put in place, and the president is a pro-economic growth president. I think tax cuts, regulation cuts are important. I think you've heard on several of the large bank earnings conference calls a sense of optimism amongst CEOs within the United States in terms of investing now in the country. I think that's going to go far in terms of continuing to drive growth. Having said that, I think there's a little nuance. Obviously, the S&P is dominated by a handful of companies which have higher valuations. I think the S&P on 12-month forward earnings is probably trading around 22 times. If you look at the S&P mid-cap or smaller cap, and you look out over the next couple of years, they're trading below 15 times. I think that many of the policies that are likely to be enacted by this administration are really going to help sort of small, mid-sized businesses and the people that sell to those businesses. So I'm quite optimistic. I think perhaps the game is changing a little bit in terms of where those opportunities are. But I do think that there are substantial opportunities, and it's a good time to be bullish for sure.
People lately have soured a little on small caps. That gives you an opportunity to buy, you think? I mean, if rates don't come down as much as people thought, the whole thesis gets thrown off, doesn't it? You can see there we're showing the Russell.
Yeah, I mean, I looked at the S&P mid-cap on the next 24 months, probably trading around 13 times, mid-caps around 14 times, large caps around 20. So, I'm not saying you have to be selective. You're not buying 400 or 600 or 500 stocks. But those seem to be fertile fields to be searching for ideas, obviously, where the growth rates are now almost equivalent to where the mega caps are trading, and the valuations are significantly lower. So I also think on a regulatory side that, regulation and other things have been a burden on some of these smaller businesses without global operations. Interest rates are clearly the risk. It's what I think is one of the biggest risks to the overall markets in 2025. And that has more to do with policy choices made by the central bank, less so about where I think inflation is going. Rates are meaningfully tight here, and everything is really coming in. The last two numbers we have were very positive for getting toward that 2 to 2.5% Fed inflation goal. So, I do worry about mistakes at central banks and keeping rates way too high for too long. But I'm definitely in the dovish on inflation camp, like Waller and others are.
What about tariffs? And once again, you are in a part of the world that could be impacted by that.
Well, tariffs as it applies to the U.S. market, every central banker where you have a national sales tax and that tax is increased by 1% in a single year looks through that for longer-term inflation. So I'm not quite sure why this Federal Reserve is referring to that. When you talked about the press conference at the 50 basis point cut in September, what they talked about was, rates being meaningfully tight. They talked a lot about many of the things that were sticky in inflation being non-market numbers. The difference between owner's equivalent rent and the Zillow rents is enormous in the market. So you shift that to after the election, and all of a sudden, we're worried about sticky inflation again when previously it was, non-market rents. So my concern is that the Fed reacts. This sort of happened in 2018. Inflation was quite subdued. There was concerns about tariffs and what the inflationary impact would be in growth from tax cuts. And, they raised 4 times in 2018, caused a market crash in the fourth quarter of 18, and then had to quickly reverse and start cutting rates in 19. So, I'm less worried about what the inflationary impact of tariffs are, which I'm pretty confident will be minimal. And I'm a little bit more concerned to the reaction function of central bankers because real rates are very high right now.